We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always find out more about Brian J. and Brad and the team at Decker Retirement by going to their website, deckerretirementplanning.com. And I start the show every week the same way because I think it's important. You can learn more about Brian and Brad and the team just by going to the website, deckerretirementplanning.com. But you also have the ability to go to, on that website, under the heading of Safer Retirement Education, there are 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's a 3 Principles of Retirement book. There's a checklist challenge, sample income plan. That's just 4 of the 12 things you could download. And it's really all there for your information to help you understand a little bit more about retirement, because that's what it's right there in the name, Decker Retirement Planning. So it's a great opportunity, I think, to kind of do a little study and research on your own. So under the heading of deckerretirementplanning.com, the heading of Safer Retirement Education, all that is there for you. Great place to start, probably Brian's book on retirement, The Decker Approach. Today, Brian and Brad got a lot to get to. So, Brian, I'll throw it to you because I know you'll be throwing it to Brad.
All right. Thanks, Mark. We're going to cover the transition where people have spent 40 years building for retirement and then transition into retirement. Now, the tools to get you to retirement are called accumulation tools. This is buy and hold. This is asset allocation. These are indexing. This is a lot more exposure to risk because in your 20s, 30s, 40s, 50s, markets take a 30, 40 plus % hit. No big deal because your income's coming from work and you've got the time. You've got 3 to 5 years for the markets to recover. And every 2 weeks, you're kicking money from into your 401k in a down market. When the market does recover in 3 to 5 years, you're better off because you dollar cost averaged into a down market. The accumulation strategies helped you in that situation in a down market. Now let's switch it. Let's say you're 65 years old, markets drop 30, 40, 50%. The portfolio that you have now is not being added to every 2 weeks. In fact, it's being diminished every couple of weeks because you're drawing income for your golden years of retirement from that portfolio that's now down 40 or 50%. Now, that is a game changer. That sends you back to work. You got to sell the home, move in with the kids. You got to make some major plans, plan B, because the rules of accumulation that help you get to retirement are not the rules that you use in retirement. Brad, let's go into detail on all the different changes. I mean, there's many that need to be changed to adjust for accumulation to distribution. Go through all of them.
Yeah, I mean, there's a lot to talk about here. It's why we have our famous 4 to 8 meeting planning cycle before we actually bring someone on as a full-time client. But I think the biggest one to me, it all just starts with having that plan and specifically having that income plan for how you use the money that you spent a lifetime accumulating. That's so crucial in my conversations with helping people graduate from their accumulation years into what we like to call the distribution years. When you have that income plan, not only are you going to feel confident that you have a source of planned income, but you also are investing the right way to meet that plan. Your investment strategy is more the result of the plan rather than your investment strategy being something that's out in a pie chart with a certain risk profile tied to it. And then that drives how you use your money. You want to go the other way around. So I think it all starts with the plan. Once you have an income plan, there's a lot of things that follow that, how you're going to use your money at different stages of your life. And what naturally follows from there is where the money is going to be drawn from. And I think most people, when they don't have an income plan, they're going to use something that's referred to as like 80-20 or a 60-40. It basically says I have X amount in stocks and X amount in bonds. And the problem there, to what you were saying, is that a lot of times when people are using that pie chart approach that got them to retirement, oftentimes those fixed income vehicles are going to be something called a bond fund. Now, for those of you paying attention, this is a big one. If you went through 2022 and had a loss on your portfolio that was larger than, let's just say, what you thought would happen. You're in a conservative portfolio or moderate, and you opened up your statement in June of that year, and you're like, oh, goodness, I am down a lot more than I thought I would be. I thought I was in a conservative portfolio. I can almost guarantee you that it was because of bond fund performance that Brian was addressing there. Bond funds are in no way a principal guaranteed or way to protect your portfolio against losses. Bond funds have no requirement to return your principal that was originally invested. You own a share in a fund, and that share has a daily market price. When we go through interest rate cycles, bond funds can very easily fall out of favor. Specifically in a rising rate environment, that's what we experienced all through 2022, where the market expected yields to go up. Those bond funds ended up being literally more risky than your stock portfolio. And there were advisors that had to sit across from people that are now my clients and say, yeah, this conservative portfolio that you have is down more than 20, 25. I think I saw one that was down 33% for a conservative allocation. And it just is a perfect case study to me of how bond funds are not the place to put your safe money. When you get to the retirement stage and you have that income plan underway, knowing that your money is going to come from someplace that is protected against losses is one of the first things you want to focus on as you upgrade your portfolio to being something that's more appropriate for retirement. And a big part of that is moving away from bond funds.
Hey, Brad, I just want to give a quick history. From 1940, the 10-year Treasury was at 2%, went up to almost 15% 40 years later, a rising interest rate environment for 40 years. And then almost 15% in 1980, we dropped down to 0.27% in August of 2020, 40 years of declining interest rates. At 0.47%, any advisor that kept people in bond funds, I feel like wasn't really paying attention, because now you've got tremendous interest rate risk. When interest rates go up, you lose money in bond funds. Whoever stayed in bond funds in the last almost 4 years now has lost over 35%, and their advisor was telling them that that's their safe money. So there's many other options available. We, as a firm at Decker Retirement Planning, we don't use bond funds for safe money because we are clearly in a rising interest rate environment. Brad, here's another tool. You talked about a plan, the plan being different. The pie chart is a pie chart which tells you how you're diversified in your portfolio. Does it tell you anything about how much income you can draw? Do you use it for income planning or for tax planning? How could you use a pie chart, Brad? I'm kind of being sarcastic.
Yeah, I mean, that's to me one of the hallmarks of a pie chart is that I can pretty much tell what that financial advisor is working with their clients on. It basically comes down to fund selection. You're going to recommend a certain allocation. They're going to use their in-house approved funds, and that's about it. You sit down with them for quarterly meetings if they're paying close attention, maybe just an annual review or maybe nothing. But that fund selection is all they offer. And to me, I think there's so much more that comes from a good retirement plan that moves beyond just a pie chart. When you do shift that lens to moving beyond just the ratio of stocks versus bonds or what fund class versus another fund class you're using, you're starting to think more about actionable parts of your portfolio, which can include, yes, I want to have a planned source of withdrawals. And no, I don't want those to be at risk. So use a laddered principal guaranteed maturities. But now getting to your point, when we know where money is going to come from, and we know that clients are positioned with the best vehicles available, the highest rates of return and actual protection, now you can start to get into really cool stuff. Like, how can we make sure that those dollars that are received are at the lowest possible tax rate? And you can start getting a lot more tactical on some of the specific goals that every one of us has for the reason why we saved this money. You move much beyond just what you're holding and into how you use it and how to optimize it.
Okay, let's talk about a couple other rules that may or may not be appropriate, Brad. What about the rule of 100 and the 4% rule? Take those separately.
Yeah, I always chuckle at these because it just screams to me. Any rule of thumb that's out there is a way for people to interact with folks that they probably get a little ahead of themselves. Rule of 100. This is a common one when someone doesn't have a good handle on what their risk preferences are. And it's, just to simplify it, basically just says whatever your age is, you just take a long picture, whatever your age is, if you're 50, if you're 60, 70, 80, whatever your age is, that is the proportion, it's the total that you ought to allocate to bonds and likely bond funds. Using most traditional big banks and brokerage approach, they're going to take your age. Someone that's 60 years old is going to have 60% of their portfolio in some version of fixed income. And that's what would be, quote, appropriate for that stage. And again, likely this will result in a bond fund being in there. A lot easier to manage if you're a traditional broker with that. So that's the rule of 100, just as a way to gauge where you're at on your overall allocation. And the premise there being, let's move away from equities and stocks and into bond funds. And also for those of you that aren't actively managing your portfolio on your own, but you're at 401k and you're using a target retirement date fund, you've set it for 2030, 2035, or 2026. This is what they're doing. You could go in and actually see the allocation to various bond funds and equities. You'll see that overall portfolio blend shift more towards the bond fund component as you get older. Yeah. Rule of 100 just says whatever your age is, that's what goes into fixed income. Second one, though, you said, though, Brian, was the 4% rule. And 4% rule is the way that advisors will recommend a withdrawal rate with some simple back of the envelope math. And if someone says, I've saved up $2 million and I need to spend a certain amount, here's my budget. Is that too much? Is that okay? And well, an advisor that has some pretty simple stuff, they're just a fund picker for someone, they can run this 4% rule where they will multiply your total portfolio by 4%. And some concrete numbers, if you have $1 million, that's $40,000. And they'll tell you that that is a sustainable withdrawal rate from your portfolio. And here's where it gets a little more advanced. If you have that invested in a 60-40 allocation, 60% stocks, 40% bonds, and it's a withdrawal rate that is sustainable for 3 decades, 30 years. And so you can access that $40,000 a year every year, adjusted upwards for inflation every year for 30 years. At least that's the theory. The problem with it is that when you are using the 4% rule and you have that inappropriately layered on top of a pie chart, the best you're doing is hanging on for dear life and hoping things don't get bad. And when they get bad, you're faced with a pretty tough choice. Either you pause distributions, even though mathematically you're told it's okay, you can still draw the $40,000 out, or you keep drawing and just really hope that it's not going to put you into a position when you might end up in some of the bad situations like going back to work or selling your house. So the 4% rule, it's a pretty scary way to manage a portfolio that I think is in some circles accepted as an appropriate way to recommend how to distribute money from your financial assets, but there's so much lacking from it, not least of which is the fact that it actually is quite risky if you enter a particularly bad downturn like 2008.
So Brian and Brad talking today about really tips to avoid running out of money in retirement. How do we do that? And there's certainly a lot of the old rules of thumb that Brad was just talking about. We're going to talk more about this. When we come back, we've got to get a break in. It's 833-707-3030. If you'd like to have a conversation with the team at Decker Retirement, trying to figure out where you are on that road to retirement. Can I retire? When can I retire? Do I have enough? Will our money last? Are we going to be okay if we retire? 833-707-3030. No cost for this chat. There's no pressure. There's no obligation. There's no judgment either. They can either help you or they can't help you. And if they can't help you, do you want their help? Maybe you don't even need them. That'd be great to know as well. 833-707-3030. Brian J. Decker and Brad Geddes back with more of Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Again, if you have questions, you want to learn more about your situation as it pertains to retirement, it's 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. Brian and Brad are talking about tips to avoid running out of money in retirement. And Brad, you were just talking about those rules of thumb, the rule of 100. So you're 60 years old, 60% of your money should be safe, 40% can be in the market. That's kind of that rule of 100. Then you also talked about the 4% rule. And that one certainly came about in the 90s when the markets were great. And the theory was, and I think it was William Bingen that came up with that strategy. And it kind of became, well, hey, if the markets are great, you can take 4% out and you should be good. Well, now they're even saying because of interest rates, the safer money is more attractive now. They're even saying the rule of thumb is up to 6% now. What's your response to that one, Brad?
Yeah, I mean, just a year and a half, 2 years ago, it was the 2%.
Exactly.
It shows how imprecise that rule is and how much of a rule of thumb it is. I mean, the way I'd like to explain to my clients is if you were to retire in 1990 with $1 million and you start withdrawing for $40,000 a year, it's a great, if someone could make that work, that's amazing, but they've massively underspent. They'll get to the end of that time frame, and I think the math has them at more than twice the amount that they started with, even though they drew out $40,000 a year. It's very easy way to draw money out. But the problem I deal with a lot in my market and where I am in the San Francisco Bay Area, my clients don't necessarily want to underspend that much. They want to have the right amount of spending, not miss out on second cruise that they could have gone on, or maybe help their kids out with extra 529 contributions. But the 4% rule would have led to massive underspending in the market, like 2000 to 2010. Well, that person, same portfolio, same withdrawal rate, it runs out of money. And it's because they were whacked by 2 material downturns within 7 years. And it's just reaffirmed to me how the rule of thumb, to me, as a way to conduct a retirement portfolio and conduct cash flow in retirement, just falls so short of what most of my clients are actually looking for. Me, the best application for the 4% rule is for someone that's in their 20s or their 30s or their 40s and saving for retirement. They can very easily help manage a portfolio and setting up growth targets with planned or required or sought after distribution rates. The 4% rule can be a pretty good estimate. If you're 30 years old, you have a fairly aggressive portfolio. We can forecast pretty quickly some growth rates tied to that and estimate what that portfolio size will be 10, 20 years down the road. And then we can say, hey, what if we withdrew maybe 4% of that a year? But that only works because we can tolerate the lack of precision there. You don't need it to be precise when you're 30. There's going to be a lot of things that happen that move that around, but it's a good estimate. When you're retired, you need a different approach.
I just want to chime in, Brad, on that 4% rule one more, and then we'll move on. 4% rule works when markets go straight up forever for the rest of our lives. It doesn't work when the markets hit a flat market cycle. So there's been 4 times that the S&P 500 has ever traded up to a market valuation of over 30 times trailing earnings. One was 1929, and the markets were flat, choppy for 17 years. Second was 1964. Markets were flat and choppy for 18 years. The third time was November of 1999. Markets were flat and choppy for 14 years. The fourth and latest time markets hit 32 times earnings November of 2021 And if history repeats with 100% historical credibility, we're looking at a really tough time of flat, choppy markets over the next 10 to 15 years, where in a flat market, let's use the latest complete flat market cycle. 1999, you retire in November of 99, you've got, name it, $2 million. Well, markets go down 50% over the next 3 years, but you lose more than that because you're drawing 4, 4, and 4. You're down 62%. Good news, markets recover and go up 100% back to where they were in the next 5 years, but you don't get that because you're drawing 4, 4, 4, 4, and 4. And then you take that hit in 2008. And we saw proof that the 4% destroyed many people's retirement plan, because in 2009, William Bengen came out and discredited his own strategy. And we saw a lot of gray-haired people coming back to work in banks, fast food, Walmart. They had to sell their home, move in with the kids. The 4% rule does not work in a flat market cycle. And history is saying that we've just started a new one. So we want to warn people as a community service that the 4% rule, if you're getting that advice as a distribution strategy, that things have changed dramatically. We're in an up interest rate cycle, and we've got market valuations that historically have shown a peak. So we want to warn people against the 4% rule. Brad, on the history of the rule of 100, it's kind of on the theme of de-risking your portfolio. What do we do and suggest people do? And it's a hard habit to break, Brad. For 40 years, they've had, a 70-30 portfolio, and then they come in to see us and we're telling them to make a change. What are the elements of de-risking or lowering the risk of a portfolio as you transition from working to retirement?
I think there's two parts to de-risking a portfolio, or what I like to call graduating your portfolio from the accumulation stage to the distribution stage. The first part is the actual risk reduction that comes from incorporating laddered principal guaranteed maturities that do structurally, they insulate your portfolio against any downturns. So I like to tell my clients that they're transferring the risk of loss from their balance sheet and onto a balance sheet of the receiving institution. So you want to de-risk first and foremost by making sure that your safe money is actually protected against losses, not just less volatile or smaller maximum drawdowns. That's step one. The second one is I think about taking my clients backwards through their portfolio. And you set aside the right amount of money for the right amount of time that you need to draw from. That's your principal guaranteed assets. And you forecast out maybe 10, 15, 20 years of that principal guaranteed source of money. And what you're left with is an amount that is not needed for 15 to 20 years. So you now can invest the money that's in what we call your risk bucket. So the risk bucket ends up being a reflection of the fact that you're putting away money to draw from your structurally protected principal guaranteed assets, the pieces that are insulated against losses. And you take the remainder. And this amount is where we do reduce risk further, because we have an amount that is smaller that is at risk. You don't need principal protection on funds that are not needed in 15 to 20 years. So we can be a lot more aggressive with the investment strategy there, because we're using a smaller amount in the risk bucket and we're creating the distance that's needed for that risk bucket to perform well. Now, going further on the risk bucket, how you invest the money on the risk bucket, there's a lot of different things that you can tweak to give someone the right growth that they want on that and the way they grow it. Things like two-sided models, active protection against losses, or periods of time where you can actually stay out of the market if things are looking a little scary. But the most important thing there is you reduce the amount of money that's at risk, make sure your safe money is actually safe, and then you invest accordingly.
Hey, Brad, I just want to add to that on de-risking a portfolio. There's three parts to it that want to mention. One is quantitatively lowering people's risk. I think that people are out of their minds if they have 60 or 70% of their portfolio still at risk while they're in retirement. That is unnecessarily high risk. Second is we eliminate interest rate risk by never using bond funds. That risk is totally eliminated. And third is we strategically lower people's risk by offering correlated and non-correlated risk strategies. We'll get into this more in the next segment, but we offer risk strategies that make money when markets go up and are able to make money when markets go down. We can drill down more on that in the next segment.
Yeah, so there's a lot to think about. When one of the still biggest concerns, it doesn't matter really how much money you have. The thought is always there, boy, I hope we have enough money to last as long as we are here. Make sure the money lasts as long as we are alive. And there are certainly challenges to that. And that's part of the process, the safer retirement process at Decker Retirement. It focuses on income planning, but really it's about distribution planning. Where's your income going to come from? How much do you need to maintain your lifestyle? None of us really want a grander lifestyle. We just don't want to go backwards either. We worked awful hard for our money. We want to make sure it lasts as long as we're here. If you have questions, 833-707-3030. No cost for this again. It's an opportunity for you, I think, to get some clarity into your retirement picture. 833-707-3030. Might be one of the more important phone calls you make. Certainly today, 833-707-3030. Back with more with Brian J. Decker and Brad Geddes of Decker Retirement Planning right after this.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, you can always go to the website, deckerretirementplanning.com, to learn more. You can also go to the heading on that website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There's like 12 different things you can download, including Brian's book on retirement, The Decker Approach. So you have all that opportunity for you to do your own really due diligence, your own research about retirement with all that information that's on the website just for you. You can always call the team as well, 833-707-3030, and just say, hey, I got this question. I got this concern. What do you think? Are we going to be okay? Can we retire? 833-707-3030. I'm Mark Elliott. All right, Brian, I know you're delving more into the keys to not running out of money in retirement. Where are you going now?
Let's have Brad. Brad, you gave us a lot of great information about the difference between accumulation strategies to use to get you to retirement and how those same accumulation strategies, if used in retirement, will actually hurt you. People need to transition over to a distribution plan. So why don't you, with incredible, vivid illustration for our radio listeners, describe what an income plan actually looks like and contrast that to the pie chart?
Yeah, I think what an income plan to me does is that it looks at someone's overall household income sources. And what we're looking to do is get, at least early on in planning for clients, is understand really clearly what is the most amount of cash flow that family could spend on in a given year without having any risk of running out of money, without overspending. And this is, I call it a max income plan. And the max income plan is a super helpful starting point, because as long as we can spend less than that, we're in really good shape. Someone has, let's say, $150,000 a year that's available from various income sources, portfolio, a rental property, pension, Social Security, a bunch of different sources to draw from. And it cumulatively produces $150,000 a year. And if they, in their best year, have needed, $120,000 a year, or $100,000 a year, or $80,000 a year, you name it. In those situations, the max income plan is super helpful, because now we know that they are definitively in a really good position for drawing money. Now, if you're using the 4% rule, you kind of can land on a withdrawal rate, a sustainable withdrawal rate that supposedly is going to carry you through retirement. But like we talked about earlier, it's all you have is an estimate. It's an estimate that, frankly, is going to change from year to year, even though the math doesn't say you need to change it year to year. The way that people live, if things are rough and they look at their portfolio that was $1 million and it's now $700,000 or $600,000, they're going to tighten things up. They're going to start getting concerned, and that advisor is going to be called quite a bit that year as they're doing very large withdrawals. So the 4% rule, the pie chart, is nothing but an estimate. It's nothing but a way to sort of guess at what a withdrawal rate is. Kind of are left to manage it year to year by yourself. Income planning is a much better way to go. But there's another approach that I also don't like, and this is the budget-driven approach. The budget-driven approach is where people don't know what the most amount of money is that they can draw. They let their budget drive how they withdraw money. And the problem I've run into this situation, and where my offices are, is that when people are only focused on what they need in order to live happily, well, if you fast forward 20, 30 years, a lot of people, I mentioned this before, but a lot of people have actually underspent. They spent less than they could have. And it's not that I'm saying go out and spend on frivolous things like jewelry and cars, but spending in the form of, say, giving money to family early and often, possibly someone that would be charitably oriented, but just was nervous about what was going to happen in their 80s and 90s. Well, when you use an income plan that's looking to very, very quantitatively land on a portfolio strategy that gets you a maximum level of income, well, now you can take that and use it for things that go beyond your budget. You can actually start making a difference in people's lives that you care about, or be more charitably oriented money. So I think, while the 4% rule is by far the worst one to use, it's just an estimate that puts a lot of people in troubles in down markets. You have the budget-driven approach, which is also pretty common, but I think people miss out and frankly underspend a lot if all they're doing is focused on meeting their day-to-day budget items.
What I like about the income plan that we use is it identifies all the different income streams. So security income streams, husband and wife, it identifies pensions, any rental real estate, portfolio income, totals them up, and then it subtracts taxes, and then identifies annual and then monthly income per year with a COLA, cost of living adjustment, to age 100. We don't think that you'll live that long, but if you do, the money's going to be there. And so that allows us to do incredibly detailed income planning for clients based on what to expect with conservative estimates for their income for the next several years. And then, Brad, we also use those income streams. Some we can adjust, some we can't. So, for example, Brad, what happens if people are right on the edge of 24% to 32%, or their IRMA limits? Describe how we can modify the income from their portfolio so that they don't drive up extra costs.
Yeah, withdrawal order, right? So this is one of the biggest questions I get from people that are moving from a typical bank or brokerage that help them accumulate enough to be able to retire, to them sitting across from me and wanting to know the mechanics. How does it work? Where do we draw from? Well, that's a super important one to understand, is what important thresholds do we have the choice to avoid? Things like IRMA, or the next tax bracket, going from the 22 to 24, or 24 to 32, federal tax brackets. But when you're paying really close attention to building out a portfolio strategy that's going to maintain a level of income that we need to set up for our clients, well, part of that has to be, where does the money come from? because it's not just smashed together pie chart. It is deliberate, thoughtful portions of their overall portfolio set up to meet those income goals. And so we do want to focus on withdrawal order there and make sure that we are drawing from accounts like, for example, their after-tax holdings that are very inefficient for long-term accumulation. Well, that can be a great place to draw from during the first 1 to 5 years of their retirement. Drawing down on those after-tax holdings. Maybe there's some capital gains incurred, but now we're removing that from future taxation down the road and allow those tax-advantaged accounts to continue to grow and compound as much as we possibly can. So again, it all comes back to planning out those income sources, and withdrawal order is one of those levers we want to pull so that we can maintain the lowest possible tax bracket for our clients for as long as we can.
Brad, how often do people come in and with the income or distribution plan that we've got, how often do they think that they can get X and they get X plus 50%? What percentage of your clients get a lot more per month using our distribution plan than what they expected?
Yeah, the majority for sure. I've found, and I haven't figured out if this is just by nature of where I live, but clients that I generally am talking to, if they're coming to me from another bank or a brokerage, one of the big sign folks on the strip malls and big known names, I'm almost always walking them through a portfolio that they're surprised to see how much more income is available to them than what they were being told through some of those rules of thumb that we talked about earlier on with the pie chart, 4% rule of 100. It's very much a majority of people have more income, more cash flow available from their portfolio than what they thought. And that's why this max income metric is so important, because then it just opens the questions. Well, what do you want to do with all this? What do you want to do with the surplus? You oversaved. And at least if they've oversaved, at least they'll go into retirement knowing that not only are they in really good shape for retirement, but they don't hold back on those things that they're going to enjoy the most when they're young and healthy. I like to say as young and healthy as they're ever going to be. And if there's anything they can do to make their early retirement better without having the fear of overspending when they're younger, that is what I think is such an important goal for people to accomplish with their advisor going into those initial stages of retirement.
Brad, another thing when it comes to the planning that we do, I love how we draw income from a foundational laddered principal guaranteed account. So now we're isolating one set of the income sources for clients in retirement. That's their portfolio income. There's 4 key parts of drawing income from laddered principal guaranteed accounts. So imagine, radio listeners, we've got bucket 1, it's a money market account. Bucket 2 is a 3-year account, 3-year CD. Bucket 3 is a 5-year CD. Bucket 4 and 5 are 7 and 10-year principal guaranteed accounts. And then you've got your risk account. So if you can imagine that, we've got 4 key parts of what that does in retirement. One is it allows you to go through a horrific period like 2022, where the S&P was down 19%, bonds down 20%, NASDAQ down 33%, commodities were down. A lot of people took a beating in 2022, and our clients that did the entire portfolio with us, they actually made money that year. Not a lot, but they didn't take those hits. So number one, you have tremendous peace of mind when you draw from laddered principal guaranteed accounts. Number two is you're using compound interest to your advantage. You're drawing from the lowest earning accounts first, allowing the higher earning accounts to grow and compound while you're clicking off these different buckets. Number three, we are in the 15, 20 years that we're drawing the income down from buckets 1, 2, 3, 4, and 5, we're allowing 15, 20 years for the risk bucket to grow and replace the starting amount of what you started retirement in. Say you saved 1.5 million, 2 million, 3 million, whatever it is, call it X, that's the starting amount. Well, in 15 to 20 years, you're drawing out multiples of X, but it allows the risk bucket to grow and compound over those 15 to 20 years to more than replace the starting balance. And then the last thing is we are very conservative with the estimates that we use. For example, bucket 1, we have at 1%, it's earning 5 right now. Bucket 2, we have at 3%, it's earning 5.5 right now. Bucket 3 is a 5-year account. We're showing 4, it's actually earning over 5.7 right now. And then buckets 4 and 5, we're showing 4%, and it's averaging over twice that. And the risk bucket is showing 6, and it's averaging multiples of that too. So we do that for a couple reasons. One, we want our clients to hear the words, they're human. Every year when we do our annual reviews, they want to hear the words, you're ahead of schedule, number one. Number two, we want our clients to have high confidence that the next year's income level is going to be at least that.
So if you have questions, you want to learn more about how this affects you in your current situation, and then obviously your future situation when you get to retirement, 833-707-3030. Again, no cost for this. I think it's a great opportunity for you to get some clarity into your retirement picture. 833-707-3030. One more time, 833-707-3030. Brian and Brad back with more to wrap up Safer Retirement Radio. Right here, we're back with more after this.
As the weather warms, the open roads begin to beckon. If you've been getting the itch to travel, call Brian at 833-707-3030 to make sure you have enough saved to keep the winds of adventure blowing in retirement.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio. I'm Mark Elliott alongside Brian J. Decker and Brad Geddes of Decker Retirement Planning. Glad you're with us. Again, DeckerRetirementPlanning.com under the heading of Safer Retirement Education, 12 things you can download, including Brian's book on retirement, The Decker Approach. You can always call with questions or concerns that you may have. 833-707-3030, 833-707-3030. All right, Brian, you and Brad have covered a lot of ground today. Final segment. Where are you going to go in this one?
Let's talk about successful retirement and define what that is, and talk about, sadly, not so successful retirements. And Brad, I've seen both. Well, let's define what successful retirement is. It's not a matter of asset size, in my opinion. How would you define a successful retirement?
Yeah. I think of it as needs, wants, wishes. So successful retirement to me is someone that's able to very comfortably meet a quality of life that they need to have in order to make retirement work. Those are their needs. So it goes beyond just covering food, shelter, water. The next layer is those wants. There are some things that go beyond just being able to travel adequately and see family, but trying to do it in a way that allows you to do more than really reward yourself for having worked as hard as you did and be as diligent at saving and putting money away. So most of my clients usually want to clear their needs pretty handily and show them how far they can get into those wants for things that maybe they didn't realize was possible. I always jokingly tell my clients that people that are most successful, they're well into their wants, and I start encouraging them, hey, maybe you should get that second massage every week that you've been holding back on, and now we have the budget to be able to do that. So the needs and the wants are really key for a good retirement, and covering that with the income plan is key. And then when you get to the wishes, this is where retirement becomes really special. This is where there is definitively surplus in someone's savings. And that surplus becomes a source of enormous flexibility. And that's where you get into some really cool trust techniques, tax lowering strategies, estate planning goals. But I want to cover those needs and your wants to have a good retirement, and then get into the wishes.
I would say, Brad, that I've seen success in retirement. I'm going to separate this out from asset size. I've seen people with very large assets that don't think that they could possibly retire yet because their wants are much more than their needs. When you add them both together, I'll just never forget one situation where a couple swore that they could not retire on less than $18,000 a month, and it forced the poor woman, who was younger than the guy, to keep working in a job that she wasn't happy in. I felt terrible for them. They had the assets to retire comfortably, but they just couldn't give up enough things in budget so that they could be financially free. And then in contrast to that, I've seen people with what I thought were very small monthly incomes of maybe $4,000 or $5,000 a month, and they had tremendous freedom because their budgets, what they spent was far less, and they had financial freedom and to go do the things that they wanted to do. So one is living within your means creates financial freedom and an incredible retirement. And Brad, the other thing I wanted to talk about is the people that are engaged and have a planned retirement. So a successful retirement is also one where you don't retire, pull the cord, you're done, you sit at home, you think, now what am I going to do? No, you're engaged in the community, in your lives of your children, your grandchildren. You're going on trips, you're hitting your bucket list, and you've got the biggest smile on your face because you're enjoying your golden years of retirement. I'll never forget, not once, twice, or three times, but several times reading the name of a company where engineers would, for 40 years, wake up at the same time, pack the same lunch, go to the same office, do the same thing for 40 years. And when they pulled the ripcord and retired, they were dead within a couple years because they were just on a treadmill. So we just warn people of that they have a plan in retirement, be engaged, and just really thrive in their golden years of retirement by having a purpose and having it mapped out and planned out to really make a difference. Brad, what would you add to that?
Yeah, I completely agree with what you're saying there. Having that plan for how they're going to draw the money out, knowing what the right amount of money is going to be, because you're right, I come across those same situations, and it's always going to, I don't know why I'm going to form a concrete opinion on this, but for some reason it always happens that people that have saved the most need the least. It's just an oxymoron out there that I see is the folks that really only need $5,000-$6,000 a month, maybe 8 to 10 or something like that, that they usually have plenty to be able to live on, but they would have gone through life feeling like they were going to run out of money anytime. And I never want someone to do that. I don't want someone to feel like they're constantly at the mercy of the next market wiggle downwards. Markets aren't always going to be moving in our favor. I mean, we'll take it while we got it, but I don't want people to be unsuccessfully going through retirement because they feel like they're going to run out of money and they're stressed about their portfolio and they're not sure if they've saved enough and what's going to happen if they live a little too long, or if they end up in health care issues when they're in their 80s. I mean, all that stuff is why we spend so much time building those plans. That's an unsuccessful retirement. That's where someone hasn't really thought through the different risks that they need to mitigate and set up a true plan for how to mitigate those risks with financial strategy. So yeah, I couldn't agree with you more on just got to identify all those things. They are knowable to some degree. And you don't want them to just be something that's unaddressed because it's a tough conversation.
A big picture on this in the last few minutes of the radio show here is to make a plan. Actually, if you're close to a piece of paper, there's 6 key parts to a final retirement plan. One, Brad illustrated this beautifully. One is to have a plan. Have a plan that shows your portfolio, where you're drawing your portfolio, how much income that you need from all your different sources, total it up, minus taxes, annual and monthly income with a cost of living adjustment to age 100. One is to have a plan that works in retirement. Number 2 is tax minimization strategies, comprehensive tax minimization strategies, properly using the donor advised fund, the Roth conversion, the charitable remainder trust, the GRAT, the guaranteed retirement annuity trust, the ILIT, the irrevocable life insurance trust, and many, many more, to have comprehensive tax minimization strategies in place. The third is risk reduction. In retirement, you can't afford to take the same risk of your accumulation years in your 20s, 30s, 40s, and 50s. The rules change. So we talk about in detail risk reduction. And then number 4 is, this really sets us apart as a firm, and that is portfolio optimization, making sure that each part of your portfolio is optimized and getting the best return possible in that category. Number 5 is income optimization. If we're reducing your risk and minimizing your taxes and optimizing your portfolio, we, by definition, by default, are also optimizing your after-tax monthly income. And then finally, fee minimization, making sure that the fees that you're paying are less than what your neighbor is. For example, the typical, and this is a data point you can look up, typical person 65 in retirement in the United States is paying 1% on their portfolio. Well, our clients don't pay a management fee on any part of their portfolio except for the risk bucket. And the risk bucket is about 25% of the portfolio. Because we charge 1.4% only on about 25% of the portfolio, that works out to be 0.3% and a 70% savings versus their friends and neighbors that are paying 1%. So those are a good reference point, those 6 key points to a final retirement plan.
Yeah, so Brian, there's only one other thing I would add in there, and it's tied to the tax planning component to what we do. And I mentioned before, a good retirement plan is going to start with your cash flow. It's going to start with your income plan. The income plan leads you to the withdrawal order, where you draw money from, and it allows you to invest it in a way that makes sure that that money is there in the future. You're not using like an income annuity or an income rider or something here. You're drawing down on your portfolio from the right source. It's properly invested to meet that cash flow. And then you take the remainder and you allocate it to a longer term holding, 15, 20 years out. But part of that withdrawal order, what it allows us to do is, I mentioned this before, it allows us to target a very low tax rate early on in retirement. And this is probably glossed over it too quickly before when I was talking about withdrawal order, because it is actually really crucial to how the long-term tax plan for our clients works out. We take advantage of those lower income tax years, those lower years where you're deliberately drawing from a source that has a very low, if any, tax impact on your 1040 that you file. And with that low tax bracket, you can take advantage of that to do something that's called a Roth conversion. You haven't heard of it yet. Pretty popular right now. I've noticed a lot of firms marketing these. Unfortunately, not a lot of firms have I found actually follow through with it, and they don't actually end up helping their clients with it. They tell them to just go contact their CPA. We are different. We actually help our clients do this every year so that we can take advantage of that lower tax rate early on, first 3, 4, 5 years, drawing from sources that have very little or no tax impact for a client to move deliberately portions of an IRA, a tax-deferred asset, into a Roth IRA. Do that, it can generate a tax liability, but now what we're working to build up is a portion of our clients' funds that is going to have tax-free growth on that Roth IRA, and they're going to have a tax-free source of income eventually whenever it comes time for them to start drawing from it. The only way this is possible, or else we'd be just kind of shooting blind here, is by knowing what sources that they ought to draw from early on, and also knowing, being really thoughtful around how those funds are invested to make the goal of drawing from a lower source of taxes in the future. And a lot of times people like to know, well, how much should I do? Should I just convert all of it to Roth IRA? No, hold your horses. Take the amount that we can move without pushing you to a higher tax rate. So if someone's in the 22% tax rate, we want to make sure they stay in that ballpark. Maybe we go to 24. We stay within that band of a tolerable tax rate. And that tolerable tax rate can be a guide for how much you want to convert on an annual basis without pushing them into an unacceptable tax rate. It can be $10,000 in a single year. It could be, I think my largest conversion last year was $150,000. It can be rather large numbers to do a profitable, beneficial conversion of that IRA to a Roth IRA. And then what we're working to do is get that entire risk bucket moved to a Roth IRA so that all their income is completely tax-free in the future. Pretty cool process that fits well with our income planning approach.
Yeah, so at the end of the day, everybody's situation is unique, and that's how Brian and Brad and the team at Decker Retirement look at it. Should you be moving some money to the Roth? Maybe, maybe not. Everybody's situation is unique. But again, Brian and Brad have covered a lot of ground, as they always do. You have questions, you have concerns. Give the team a call. Get some clarity into your retirement picture, 833-707-3030. Again, there is no cost for this whatsoever. I think it's one of the more important phone calls you can make, actually giving you some clarity into your retirement picture, 833-707-3030. 833-707-3030. So thanks to Brian J. Decker and Brad Geddes of Decker Retirement Planning. Thank you for being with us. Enjoy the rest of your weekend. We're back with more Safer Retirement Radio next week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.